Hi there. I wanted to put together a very short video looking at market volatility and in particular how it affects you when you're trying to master or work through your retirement planning. It's important for us to understand the present by also looking at the past. And I think as we go through this little journey, I think you're going to find it very effective in helping us understand why it's important to not only have a diversified portfolio, but also to look at the opportunities that have presented itself in front of you. Well, I think the question to ask here is, how do you feel about volatility? There's no question that we've been living through a very volatile period, but more importantly, we have to understand the only thing that will be constant is change. As you can see on the chart on the right-hand side, the forecast was completely wrong for the S&P 500. As a matter of fact, since March 9th of 2009, the S&P 500 is up over 350%. That said, I believe that there is a residual hangover from that event from individuals and also professionals alike. They've just never recovered. They're constantly looking back at that event, waiting for the next shoe to drop. Since March 9th of 2009, investors have lived in a constant fear of the next crisis, or the next crisis du jour, some of which I've listed below, but it's certainly not an exhaustive list by any means. We've had a Grexit, we've had a Brexit, we've had a fiscal cliff, and today we have the coronavirus. As a matter of fact, we've had many events that at any moment in time, each look like what might be a permanent barrier to future financial success. But in each one of these instances, and many others, the first reaction of the stock market is to always go down. It then takes a period of time to recover, but over each and every one of these cycles, it has continued to reach new highs each and every time. Now, all of you have had a globally diversified portfolio, and if you've been with me since December of 2008, as evidenced here, you've had an extraordinarily good market return. The S&P 500 total return in Canadian dollars has had a compounded annual return of 15.3%. The Morgan Stanley Compound Index, or MSCI World Average, was at 12.5%. Europe was just a hair under 9%, and Canada just a hair over 9%. So if you had a portfolio, very simply, that we just allocated 25% of your equity exposure to each one of these, you would have had a compound annual rate of return of 11.3% simply by just being there. This is a very good rate of return, and especially when we have a very low inflation environment. The largest issue, though, is that most people outside of you have not had these rates of return, and I'm going to show you why. This slide represents the evidence that many did not participate in the biggest bull market in history in the United States. What we're looking at is the cash flow moving into equity and fixed income funds in the United States. What you can see is that since 2008, equity funds largely, almost without exception, have had net redemptions, money coming out over the entire time period. Whereas money was coming out of the stock market at precisely the exact same time that it was achieving new highs consistently over that decade. It then moved into fixed income investments, which essentially were paying a little bit more than zero. I believe that this is a huge cost of opportunity lost, that in many cases simply might not be recoverable. And now we're experiencing a new exogenous shock called the coronavirus. And the question is, as captured by The Economist magazine, how bad will it get? And I offer that not only in the context of a healthcare scare, but also how bad will it get in the stock market and how bad will it get in the economy? Recently, we've been experiencing a tremendous amount of volatility in the stock market. So I wanted to present a short-term model of how we try to look at the world. As the graph demonstrates, the S&P TSX has delivered an annualized rate of return of 8.93% over that period of time. It has proven to be incredibly resilient throughout the worst market conditions, because if you had started off with $10,000 in 1956, it would be worth $2.2 million today. Now, over the same period of time, there's been many instances where the S&P TSX has fallen by more than 10%. And if you look on the chart on the right-hand side, you can see that it's actually happened 24 times since 1959, and yet each time the market has recovered and achieved a new high. Throughout history, equity markets continue to experience volatility, and yet despite this, they continue to be resilient. This slide represents what I call the 70% advantage. What you're looking at is the calendar year returns, year by year, ranked by ranges of returns. So you can see 0 to 10% or 10 to 20% or 0 to minus 10% and so on, going back to 1926. 75% of the time, as you can see on this chart, you get a positive experience in the stock market. If you go back to the far left-hand side, you can see that in 2008, in that minus 30 to minus 40%, where the death of capitalism, as it was called, was occurring. Well, at the same time, the year after, if you look to the right-hand side of the chart in 2009 and 20 to 30% positive returns, you can see that capitalism itself was alive. So this is to your advantage in the stock market over a reasonable period of time. So for the past 92 years, the stock market has provided a positive rate of return on a calendar basis 75% of the time. And I'd call that pretty good odds. The chart you're looking at is the calendar year returns on the S&P 500 going back to 1980. Now there's a lot of data here, so let's just deal with the far left-hand side for an example, which is 1980. In the calendar year of 1980, the stock market went up 26%, which is a pretty good year. But what the red dot is showing is the inter-year decline of 17% that occurred. So think about what happened here. As the market begins a new year in 1980, obviously, it must have started to accelerate to the positive. And it goes up for a while. But then it rolls over and it starts to go down. And everybody has a different threshold of pain when markets are going down. So it goes down 5%, 6, 7%. And all of a sudden, we're reading about Brexit or Grexit or fiscal cliffs or tariff wars. Okay? Now, at some point, the market continues to go down. And let's say it goes down 12, 13%. And we believe that we should maybe start to extricate ourselves from the market. Well, this is fun with math only, but on that red dot, down 17%, if you got out of the market that day, your cost of opportunity was 40%. Because if you put $1 in on that day, you got a 40% return by the end of the year. That's how you win. You cannot achieve long-term goals in the stock market by consistently crystallizing losses every time it goes down, and you know that. The important thing to note on this chart, though, is those red dots. That every year, without exception, at some point during the year, there's a negative rate of return achieved. It's how you deal with that event that will determine how financially successful you are over time. And again, you know this. So what are the things that you can do now to help protect yourself? Well, have a plan and stick to it. Ensure you have a proper diversified portfolio. Invest for the long run. Determine your retirement income withdrawal strategy and that it's sustainable, and take professional financial advice. Let me just quickly remind you and go through what our approach is. Many investment advisors will only focus on how your portfolio is performing. Now, portfolio performance is important, but it is only one component of your overall financial well-being, which we call a comprehensive financial plan. Whether it be managing your cash flow efficiently, making sure we're taking care of tax saving opportunities while you're working, but also through your retirement. These are also interconnected by making sure that we're optimizing your retirement, because sharing your wealth may also be very important. Along the way, perhaps you're planning for a major expenditure, or you're preparing for the unexpected, whether it could be a premature death or a disability, or more importantly, is connecting all of these dots while working with your professional advisors, whether it be lawyers and accountants, to make sure we're all on the same page. This is how you have a comprehensive, synchronized financial plan. So just as a reminder, we do follow a process called the WISE Advantage. It's something we use with every meeting, and it's something we use all the time. What we want to make sure is that we understand who you are and what you want so that your plan is individualized. So just as a reminder, we always explore your current situation, make sure we understand where it is that you want to go and what it is that you'd like to do. From that, we develop a comprehensive plan, and then we build a customized investment portfolio. From there, we implement. But more importantly is we have to be proactively monitoring and adjust the plan just like we do on a regular basis. Thank you very much for taking the time to go through this slide deck. I hope you found it valuable. I think the key lessons here is that history does continue to repeat itself, but always in a positive way. There are crises, there are market events, and market volatility is par for the course when we're investing in equity markets in particular. Thank you for keeping the faith. Thank you for sticking to the plan, and understand that you do have a diversified investment portfolio that is taking advantage of opportunities as they present themselves, and it's also wrapped in a comprehensive financial plan to give you comfort and direction through your entire life. Take care.